Today, I'd like to tell you about our sponsor, Swan Private. Now, you know from listening to this show that our money is broken. Fortunately, we have Bitcoin, a better money that will help us build a brighter future. But if you don't have a Bitcoin strategy and a trusted partner to help you execute that strategy, then you're probably going to fall behind. Now, I've known the Swan Bitcoin team for years. The Bitcoiners at Swan are mission-driven and have deep expertise and respect in the Bitcoin space. In my opinion, this is the team you want on your side. Today, I'd like to highlight Swan's Private Client Services division, which guides high net worth individuals and businesses around the world toward building and preserving wealth with Bitcoin. So visit swanprivate.com and learn how this concierge service gives you direct access to your dedicated Bitcoin advisor by phone, messaging, and email. Swan will guide you on complex areas such as self-custody, or you can choose to hold your Bitcoin through Swan with one of the largest US-regulated custodians. So, make your first purchase with Swan Private and get $100 of Bitcoin. Just tell them that I sent you. You know, an opportunity like this to build and preserve legacy-impacting wealth for your family and company will not likely be seen again in our lifetimes. Sign up at swanprivate.com today, mention Breedlove to your advisor, and get $100 in free Bitcoin when you make your first buy.
Lyn Alden, welcome to the What is Money Show.
Thanks for having me.
Really excited to have you on. We're going to be doing a deep dive, as a lot of my audience is probably accustomed to, but I think this one's going to have a slightly different flavor. And I'm really excited to talk to you because you such a brilliant thinker on these topics that are very abstract, often kind of masked in a lot of jargon and strange language that's inaccessible to broad audiences. So I hope that, you know, you and I talking together can unravel some of this. And you probably don't need an introduction, but for my audience, you are the founder of Lyn Alden Investment Strategy, and a well-known macroeconomic thinker, both inside and outside the Bitcoin universe. And when we got to talking about this originally, we were deciding on what we should talk about. I think we've narrowed down a few different texts we wanted to focus on. But the first one we're going to start with was this was your recommendation, actually, this IMF working paper on the liquidation of government debt. And this is written by Carmen Reinhardt and Belen Shabranchia. I hope I'm pronouncing that correctly. And I think Reinhardt's the author of This Time It's Different, right?
She's done a number of works. I forget all the titles, but yeah, she's a well-known publisher of these types of papers.
Yeah, I know I recognize her name. I think I've read that book of hers that she at least co-authored. So again, really grateful to have you on. I guess what we could start with, I'll just read the abstract to this paper and then we'll start working our way through it sequentially. The abstract reads that high public debt often produces the drama of default and restructuring, but debt is also reduced through financial repression. That's a key term in this paper, which is a tax on bondholders and savers via negative or below market real interest rates. After World War II, capital controls and regulatory restrictions created a captive audience for government debt, limiting tax base erosion. Financial repression is most successful in liquidating debt when accompanied by inflation. For the advanced economies, real interest rates were negative for half the time during 1945 to 1980. Average annual interest expense savings for a 12-country sample range from about 1 to 5% of GDP for the full 1945 to 1980 period. We suggest that, once again, financial repression may be part of the toolkit deployed to cope with the most recent surge in public debt in advanced economies. So we're going to pick a lot of that apart. There's a lot of terms in there, and the authors do a great job of unpacking it. But I'd love to first just hear your general thoughts on kind of the abstract and where, you know, again, this paper was a recommendation by you, so maybe the impact that this paper had on your thinking in particular.
Yeah, it's funny because they actually lay the outline out pretty clearly, and this was published in major in major organizations, right? So they published an earlier version of this paper in 2011
Hmm.
with the National Bureau of Economic Research, which is the organization that officially calls recessions in the
Hmm.
U.S. They're the ones that basically define a recession.
Hmm.
And then they also republished an updated version of the paper here at the IMF. And so these are obviously rather large official bodies,
Hmm.
and they're basically just coming out and rather bluntly outlining what happened historically and what is likely to happen in the future regarding the real returns of cash and government debt in an era of high debt, relative to economic activity,
Hmm.
and some of the unsavory means that are employed in order
Hmm.
to make that possible. And so it's actually, they use a lot of jargon, but they're also actually surprisingly direct,
Hmm.
with the descriptions of what happens. And there, you know, my initial approach into understanding how debt cycles end was through Ray Dalio, his
Hmm.
concept of the long-term debt cycle. He's been talking about that for something like a decade now. And that's the idea that, you have these normal business cycles. You have credit expansions, credit, contractions, but that, in this modern financial system, they basically, because you have central banks and you have fiscal policymakers, when you start to get a deleveraging event, they come in, they cut interest rates, they do fiscal stimulus, they try to short circuit that at some point.
Hmm.
And then they start rebuilding debt from there. And so as a result, you get higher and higher debt over time, like higher highs and higher lows, and you get lower highs and lower lows in terms of interest rates. And that works until you hit, basically you can get higher debt, but then the interest expense on that debt is offset by lower interest rates. And so interest to maintain that debt is not really going up, even though debt is going up relative to incomes, relative to economic activity. But that stops working once you get around the zero bound or even slightly negative. In some cases, it's much harder to go to deeply negative interest rates.
Right.
Um, and so at that point, higher debt would result in higher interest payments on that debt relative to the size of the economy. And so that's when you encounter what Dalio would refer to as a long-term debt cycle unfolding, which is where you get a different type of economic environment, and that's one of higher inflation, negative real interest rates, and what this paper would call financial repression, basically
Mm.
inflating some chunk of that debt away. Yeah, and it
Mm.
could be a spectacular hyperinflation in some cases, or it could be these more subdued, longer grinds where you're just getting inflated by several percentage points a year over the course of years or decades. And so I think this is an environment where being familiar with history is very helpful because the last time we encountered public debt to GDP levels as high as they are now was back in this 1940s war era,
Mm.
which is the last time that did in Dalio's terminology would be a long-term debt cycle, and it would be the last time that there was a fourth turning. That's kind of the
Mm.
qualitative social aspect of what was happening at the time. And so I think this is really instructive. And I think one more point I'd bring up is that there was a study by Hirschman Capital a couple years ago, I believe, and they analyzed public debt in dozens of countries around the world going back about 200 years. And they found that 98% of the time, if you got to about 130% debt to GDP, you'd have a default of some sort within
Mm.
the next 10 to 15 years or so. And that default could take a number of forms. If it's an emerging market that has debt that's not denominated in their own currency, or it's not denominated in something hard like gold,
Mm.
they're more likely to restructure and outright default in various ways. Basically, say that we just don't have the capability to pay this back. Whereas, of course, if you have the liability denominated in a adjustable currency that you can print, the quote unquote default takes place in real terms where you get paid back every unit you're owed, but
Yep.
those units are devaluated in a rather uncomfortable way.
Mm.
And so they were kind of highlighting that in the current environment, we're likely to experience that type of thing over the next 10 to 15 years. And I would say in the couple of years since that paper came out, we're kind of well on our way to having that play out.
Yeah, it's quite interesting how pervasive and large this debt structure has become. And I think the Austrians were right when they rooted this in debasement of the money. A lot of the Austrian business cycle theory, the increased booms and busts you're talking about, Mises talked about this back in 1949. He said that's basically the inevitable outcome. Once you start debasing the currency, you have to get back to economic reality, either through deflationary shocks or further debasement. And if I'll try to keep bringing us back to simplicity here, because I know it's very easy to get carried away in a lot of this terminology. So if we just consider, and please correct me anywhere I'm wrong on any of this, debt as just simply a promise to money in the future, or a promise to some payment of goods or services in the future.
Yeah,
and
exactly.
This,
and of course, there's different forms. There's securities that it's packaged versions, and then there's loans, and there's ones that are issued by private entities, and there's ones issued by official public entities.
Yes. And in general, this paper is detailing how governments have both accumulated and then subsequently discharged their debts across history, both advanced and emerging economies, and all the different machinations they've used to, a number of things, to get captive audiences, as they say, to freeze capital in a certain location so they can tax it or debase a currency. And what's further interesting about this paper, I think it's IMF sponsored, or IMF is at least at the top of this paper. I don't know what their role is.
They published it, but they don't, they go on to claim that the author's views are their own. That not every statement in the paper is necessarily endorsed by the IMF.
Right, which that's what makes this interesting, is that the authors are not mincing words, using terms like financial repression as a means by governments to discharge these debts. And so, getting into the paper a bit, I will read one more excerpt here that just sort of lays out in general the framework for the paper, and then what this is going to be in regard to when debt to GDP hits certain levels. There's only a select number of ways out of it. And that's basically what this excerpt lays out. It says, throughout history, debt to GDP ratios have been reduced by one of the following, basically: economic growth, or substantive fiscal adjustment / austerity plans, or explicit default or restructuring of private and or public debt, or a surprise burst of inflation, or a steady dosage of financial repression accompanied by an equally steady dosage of inflation. Those are not, I said or between them, but I guess they're and or, you can use any combination of them. And then the authors go on to say options 4 and 5, which are the surprise burst of inflation or the steady dosage of financial repression accompanied by a steady dosage of inflation, are viable only for domestic currency debts, which I think was the point you made. If the debt's denominated in your own currency, you can just print more of the currency to pay it. So you're not technically defaulting, but you're sort of implicitly defaulting, and that you're paying back devalued currency. Since these debt reduction channels are not mutually exclusive, historical episodes of debt reduction have owed to a combination of more than one of these channels. And the last thing, this is a sentence mentioned in the paragraph after, it says, as high levels of public debt appear, or it says, the evidence at any rate is not particularly encouraging, as high levels of public debt appear to be associated with lower growth. So there's a bit of a pernicious thing here, where you need economic growth to get you out of this debt to GDP excess in an honest way, but high debt to GDP actually inhibits growth. So it's kind of a rock and a hard place situation, which then leads to all these alternative channels of debt discharge.
Yeah, and then a challenging thing is that, so austerity works under normal environments where you run a relatively balanced situation, you have, well-functioning markets. The problem is if you have decades and decades of not practicing austerity, you get to these super high debt levels that are, only able to get there due to this kind of manipulation of getting things that high.
Kicking the can down the road kind of mentality.
Exactly. Yeah. If you then try to practice austerity, you're like, okay, we've gone too far. Let's start practicing it. The problem is then you get stagnating GDP. because you're so reliant on all those things in the first place, all that fiscal stimulus, and you start trying to practice it, and then you get basically stagnant GDP. So your debt to GDP is not even going down. You're kind of just eating your kind of seed corn. And we've seen that these periods of time where they try that. Like, so for example, Europe actually tried it after the European sovereign debt crisis. They were trying to do these, get their deficits as tight as possible, and you just see no growth, and you see debt to GDP just go sideways, and that worked for a few years until they encounter some sort of external shock, and then it's all games are off, and they end up having another spike in debt. And so that's why, for example, that Hirschman Capital report showed that once you get to, like, say 130%, and there's wiggle room around the exact number, there's no magical threshold, but once you get super high, you're kind of past the event horizon of recoverability, where there's almost no way to grow your way out of it or austerity your way out of it, and that you're going to default in one way or another before you can eventually stabilize and get back to a period of more honest growth, right? You're already so malinvested that you're in that kind of tailspin that's really hard to recover from.
Right.
And so the kind of the reference to the paper, and from what I see just looking around the world today, is that we are in that kind of past event horizon stage for a lot, especially developed countries, where they can try austerity, they can try growth things, but basically one way or another we're going to see defaults. And of course, among developed countries that control their own currencies, we're very likely to see that in the form of real defaults, where just like today, I mean, official inflation's 8.5%, meat and poultry inflation something like 14% year over year, gasoline prices are up 50 to 60% year over year, and interest rates are what is it, like 0.75% and going up by 50 basis points or so every 6 weeks. So we actually have the biggest gap you've ever had between policy rates and inflation rates since the 1940s in the US and most other countries. So basically, the last time we did financial repression, we had a gap this wide, and we're kind of back in this financial repression, but most policymakers are not at the stage where they're officially doing it. They're saying, okay, we're going to get inflation under control, we're going to hike rates. That's still what the Fed's going on. European Union's a little bit more down the road of saying, we're going to be slower at doing that. And then you actually have Japan, who's doing outright yield curve control. So they're actually doing more explicit financial repression, where they're saying our inflation target's 2%, but we're going to hold long duration bonds at 0.25% or less by printing as many yen as needed to buy bonds at that peg. And so we have more explicit financial repression out of Japan, although they haven't turned to the full range of things yet. They haven't done these, draconian capital controls, and they haven't, but they are doing that explicit yield curve management.
Yeah, a couple things here. One, I mean, I would just like to point to the nature of addiction in a way. It's like governments really do get addicted to this free lunch of debt early on. And then, as we'll get into the paper, I think they use a lot of coercive means to discharge the consequences of that debt onto others. And what you said here too about the official inflation rate being whatever it is, 8%, the actual price inflation impacting people's lives seems to be much higher than that, as you said, with meat and poultry and gas, things that people actually buy. When you take that inflation rate net of the interest rate, that's the negative real yield, right? This is the actual metric of financial repression, if I'm not mistaken. And that's the same thing you described Japan is doing, right? They're saying we're just going to keep printing as many yen as necessary to buy this long-term bond, keeping it pegged at, I think you said 25 basis points yield. So basically saying they're going to keep discharging that debt through that mechanism, until they say otherwise, basically. So all of this, it's almost like the decisions to accumulate the debt are made by a few, and then they start to get discharged on everyone else over time through all these different channels. And so there's governments getting addicted to debt, but then there's these sort of obfuscating discharge mechanisms / coercive discharge mechanisms that appear to give them plausible deniability after the fact. And we see that the rhetoric coming out of the White House today is pretty is a testament to that, where inflation has nothing to do with monetary policy. It has to do with the war in Ukraine or COVID or anything other than a central bank. So yeah, I'd love to hear just your commentary on some of that. Sorry, I'm throwing a lot at you. I'm just thinking out loud.
Yeah, generally you see these ramp up, these financial oppressions ramp up during eras of wartime finance, right? So it could be an actual war, like World War II, or what we're seeing in Russia and Ukraine, or it could be, before we had this recent war, I was describing the pandemic response as, if people ask me looking at the charts, if you didn't know anything about a pandemic or lockdowns, what would you think's happening? And I would say it looks like wartime finance. It looks like
Yep.
some sort of war is happening, and there's these large fiscal responses to deal with it. And so we, during the 2020 so far, we've essentially been in a wartime finance type of environment. And during those types of periods, politicians do have more cover to do those types of policies. They can link those policies to patriotism. They have more release valves for saying where that came from. And this, the politicians in multiple countries and multiple political parties turn to this sort of, blame the other. There's things like that work because there's always a grain of truth to it, right? I mean, does Russia's impact oil prices? Almost certainly.
Right.
But it's an overlay on top of something that was building for quite a while. I mean,
Right.
for example, if you look at European natural gas prices, they blew out at the end of 2021. They started looking like this Weimar chart because you had real supply and demand problems. And they had, some currency problems and things like that. They were blowing out well before the war. And of course, the war contributes to that because now the whole supply is in question. But the actual, people forget the order of events of how these things unfold. And so I think that when narratives, normal narratives break down, when they have these types of cover, they can turn to sort of things like that. And so, for example, during the 1940s, the United States did something very similar to what Japan's doing today. And of course, the paper covers this period of financial repression, the IMF paper. And basically what we did was, we're fighting World War II. Inflation's obviously running quite hot because we're expanding a money supply by 20, 30% a year. Commodity prices are soaring because every country needs every commodity they can get in order to wage total war. And you basically the central bank said, okay, well, federal debt's 100% of GDP. What are we going to do? And so the Treasury basically captured the Fed. You had this almost merger between the two. And they said, well, here's what you're going to do. You're going to hold interest rates low and help us finance the war to win. And so the Federal Reserve held short-term interest rates at near zero. I think it was 0.3%. And they capped long-duration treasuries at 2.5%. And so they of course they did that with a peg. So they had, they were willing to print dollars to buy treasuries in order to maintain that peg as needed until the market realized that they're serious about it. So the market kind of does that for them. And then they do other things like capital controls or bank requirements saying, okay, banks, you have to hold treasuries as this much percentage of your assets, for example. To help have the banking system help finance that, to limit how much the Fed has to finance it. And so you had inflation run an average of about 6% for a decade from the early 40s to the early 50s, while interest rates were 0 to 2.5%, depending on what part of the duration curve you're on. And at one point, inflation officially hit 19% year over year during that period, and they're still holding rates near zero because they're in that period of financial repression. And the reason governments turn to that is because at that point, the alternative, if they ever default on their nominal government bonds, is that you would get a cascading default throughout the entire banking system. Right. So because we collateralize liabilities by other liabilities, it's turtles all the way down. And so if you look at a commercial bank, their risk-free capital is bank reserves they hold at the Fed, and treasuries, right? And the Fed, all of their liabilities are currency in circulation and those bank reserves that commercial banks are. So those are liabilities of the Fed, and their primary assets are treasuries.
Right.
And so if you ever have a default of treasuries, the Fed would be technically insolvent. Commercial banks would technically be insolvent. And so everything blows up. And so, of course,
Right.
rather than everything blowing up, they're saying, okay, everybody has to take a haircut in real
Right.
terms, and this is how we're going to do it. The alternative is if you don't control the liabilities, like we saw this, for example, in some Southern European countries during the European sovereign debt crisis, instead of having that type of financial repression, they had bank bail-ins. So they said, okay, this bank's going to be insolvent, but we don't control the euro. We can't just unilaterally print the euro as one of the countries in the eurozone and say, okay, we're going to do bank bail-ins where depositors are all going to get a haircut, and you're going to be issued some bank equity, in exchange for that haircut. But of course, that bank equity is now worth a lot less.
Right.
And so you get these kind of devaluations that way. So there's multiple ways to do a devaluation or a default, depending on the details. And that's the type of environment we're in today.
Yeah, it's really, really ugly. So this is almost like chronicling the band-aids and duct tape that get applied to debt structures over time. And really, as you said, turtles all the way down in terms of debt all the way down, but at the bottom of that is really gold, right? Whoever has the gold kind of makes the rules, so to speak. That's what Bretton Woods was, and all of these things. So it's interesting to me that this connection between indebtedness, I'm often reminded of that old quote that there's two ways to enslave a country. One is by sword, one is by debt. That all this indebtedness ends up entangling a lot of interest in a way that becomes really hard it becomes too big to fail, right? So you have to put more band-aids, more duct tape. You get into this real vicious cycle. And before you know it, you've just completely divorced our socioeconomic system from market realities, right? It just becomes almost a realm of pure policy changes. So, and now this gets us into this term, which again, this is one of the reasons I really like the paper, is they just call it financial repression. Like that's what they're doing, is they accumulate too much debt. So what do? They engage in financial repression on productive market actors to relieve themselves of that debt. So I'll read one little excerpt here. It says, apparently, it has been collectively forgotten that the widespread system of financial repression that prevailed worldwide from 1945 to the early 1980s played an instrumental role in reducing or liquidating the massive stocks of debt accumulated during World War II in many of the advanced countries, including the United States. Is this financial repression? Is this a difference only in degree, but not kind of outright physical oppression? Because what we're saying here is you're basically coercing and stealing from people to pay for your debts, right? When I say the policymakers are coercing and stealing from citizens to pay for debts they have accumulated in wartime, largely. Is that accurate?
I think it becomes coercion once they hit a point where they make you own that debt or make entities own that debt, despite the fact that it's getting devalued. So if they're not making entities own it, but they're devaluing it, then you could kind of describe that as a form of trickery. They're somehow encouraging people or entities, we should say financial entities, of owning this thing that is not doing very well in terms of purchasing power. It's kind of like, if they run this system and you have the ability to opt out of the system, but for whatever reason you're choosing to participate in the system, you're getting duped into basically sticking with it. Now, if that doesn't work, sometimes they do start crossing the line into outright coercion, where for example, in the United States, there's 40-year period, roughly 4 decades or so, where it was illegal for Americans to own gold, punishable by up to 10 years in prison. And so I would describe that, of course, as a form of coercion, that they're trying to block the exits before burning down the theater.
And the bail-in too was coercive, right? Or they're just taking depositor money and giving them diluted bank equity in return?
Yes, but you can describe that as trickery or coercion depending on if you had to have deposits there. So for example, as we talk, there are some crypto banks that are blowing up.
Mm-hmm.
Of course, people didn't have to have deposits there. They're these small fries compared to what's happening at the global scale.
Right.
And so if there's financial repression at a traditional bank, or bail-in at a traditional bank, the question is, did they have to have deposits there? Was some sort of mandate that they had to have deposits there, or were they kind of, encouraged to have deposits there? So again, you can call that trickery or you can call that coercion depending on the specifics. But once you get into outright forcing people to own this asset that's being devalued, then yes, I would describe that as a form of coercion. That's force. If someone wants to own gold and you're willing to put them in prison for owning gold, that would be a type of coercion. Most people describe that as a very unreasonable type of coercion. I mean, if someone wants to own nukes and you come to the door and say, no, you can't own nukes, most people would find, okay, that's pretty reasonable.
Yeah.
But if you're trying to own literally a benign yellow metal, and they're saying, no, we're going to put you in jail for 10 years because you chose to do that, that is, most people today would consider that very,
crazy.
crazy. And the funny thing is in history, there's very few, in the United States, very few prosecutions over that. It was one of those giant threat, rarely enforced because it's very hard to enforce it. And actually, that's kind of the history of financial repressions where most of the coercion in practice happens at the institutional level because that's far easier to enforce. So, if there's a few thousand banks, it's easier for them to say you have to have, say, 30% of your assets in treasuries.
Less throats to choke.
Exactly. Yeah. And they can't get up and move anywhere. They want to make money, so they want to be in the system. So that it takes a lot less force and a lot more just, you sign a couple laws and then it happens. Whereas of course, when you have a further breakdown and you're actually going out to the public level, now the number of enforcement points are in the millions, and you're more likely to get pushback. And today in emerging markets, we see signs where like Turkey said, okay, you can't use crypto for a medium of exchange. They're not outright banning ownership of it, but they're saying you can't use the medium of exchange. Basically, there's different levels that countries will resort to coerce people to use the national currency. They could say, look, and Turkey's done this, where they'll say, it's patriotic to not own gold and not own dollars and not own Bitcoin, but to own lira. And if that doesn't work, they say, okay, now it's either illegal to own these things or there's limitations on these other things. We add frictions in order to own these other things, up to the most extreme is that you literally go to jail if you own these other things or some subset of these other things. And one of the mildest forms is taxing every other asset so that the people at least have to keep going back to the currency. They can own other things, but at the end of the day, they have to go back to the currency to pay their taxes. But then, of course, each society kind of has these lines in the sand where they start to say that, well, that's unreasonable. I mean, saying that it's punishable by 10 years to own gold would cross that threshold for most people today, whereas most people are accepting of other, somewhere else on the spectrum. And so it's just,
it's really, okay. This gets into this idea that, there are cost benefit considerations being made by government and how they're going to impose these channels of financial repression, for lack of a better term. And the authors do go into this later, but I guess the easiest one would be kind of the moral suasion, like you described with Turkey, saying, oh, it's your patriotic duty to hold lira, not these other currencies. And we've seen that historically too, right? There's always in like Soviet Russia, there used to be this appeal to just nationalistic faith and devotion. It's like, we don't need price signals and all of this. You just do it for the love of Mother Russia. And that was going to be the fix to the economy. This is kind of a similar theme, but just applied to the financial arena, it seems, instead of the larger economic arena. So by way of, and this is sort of deviating off the paper, but just as a specific example that comes to mind, the Cyprus bail-in, I think that was 2015 time range. You were describing that it wouldn't necessarily be coercive if depositors were not required or mandated to have deposits at that bank. and I don't know the specifics of the situation, so please correct me or fill me in anywhere I'm off here. But as I understood it, there were depositors in Cyprus banks just voluntarily, as if you or I go open a bank account today, but then we wake up one day and it's everything over, every deposit balance over 100,000, whatever it was taxed at, some huge percent, 70, 80, 90%, something like that. Is that coercive if there, even though we were not required to have deposits at that bank, but we had deposits at that bank based on a certain contract relationship, that then that contract relationship is basically violated overnight via this bail-in mechanism? Would you classify that as coercive?
I would describe that as broken contracts. You could describe it as fraudulent. You could describe it as a default of contract.
Yeah.
And again, it kind of depends on scale, right?
Yeah.
So if there's some small bank that, say crypto bank today, given the context, and then people that lures depositors in, they default on them.
Yeah.
Was that coercive, or was that, consumer kind of malpractice? Was that, false marketing? Was it? But once you get to a bigger and bigger scale, I mean, if you're like the largest bank in a country and, you're kind of the default choice, it's closer to coercion because you have
less choices.
Yeah, there's fewer choices. People have to do more frictions not to have deposits at that bank.
Right.
I'd still be somewhat cautious with word choice around that there's still a spectrum there, right?
Yeah.
So if they were not actually forced, if there were some alternatives that people could have taken, but at the bare minimum, it was obviously a breach of contract. It was a default of contract. It was, you didn't have the choice not to get bailed in once you already had your funds there.
Right.
And so, it was a default in various ways.
So that's a great point. There's a spectrum here, right? I guess with moral suasion at one end, it's not coercive. It's just kind of a guilt trip, I guess. And then at the other end of the spectrum, there is Executive Order 6102, right? And governments are engaging in this whole spectrum of financial repression. I guess these would all be under financial repression, maybe not.
Yeah.
But as things get more desperate, clearly they err towards the end of the spectrum, like Executive Order 6102, confiscating gold and things like that.
Now I'd like to tell you about a great new Bitcoin show on the scene that you've got to check out. Brought to you by Swan Studios and Bitcoin Magazine, this show is Hard Money with Natalie Brunell. Natalie is an Emmy-nominated journalist bringing unparalleled experience to the Bitcoin media scene. And personally, Natalie is one of my favorite voices in the Bitcoin space. Each week on Hard Money, you'll get the top headlines of the week with analysis you won't find anywhere else. Hard-hitting interviews with amazing guests like myself and other top minds in the Bitcoin space. And the show will take you directly into the lives being changed by Bitcoin all over the world. Check out Hard Money at swan.com/hardmoney. Today, I want to tell you about our sponsor, Crowd Health. So, how does health insurance work? You send an egregious amount of money to an insurance company. They hold it in a pool of depreciating fiat currency. Then, when you have a large health event, you have to pay them even more via your deductible. And then you hope they will cover your bill. And in fact, 1 in 6 bills are denied by healthcare.gov plans. It's time to take control of your own healthcare bills. I'd like to introduce you to Crowd Health. It's a decentralization of healthcare using Bitcoin as an alternative to health insurance. Instead of sending fiat currency to a big corporation, you send that money to an account controlled by you, a portion of which is converted into Bitcoin. Then, if you have a big health event, you have a community of Bitcoiners that will use the money in their accounts to help you out. To get more details, go to joincrowdhealth.com/breedlove, where you can find the promo code for $99 a month for 6 months.
Okay. Just trying to set the stage here that we're not talking about bright and happy topics here. This is kind of serious. So there's another term here they use, liquidation effect. And as I understand this is effectively when a negative real rate is used to liquidate government debt onto market actors. But to have a liquidation effect, you need these captive audiences of capital, right? You need a tax base to tax. You need capital to tax and satisfy the debt itself. I guess to have the key point here is that you need, so like capital controls, all these ways to keep capital legible and accessible by tax authorities is key to this whole process. Because obviously, if people can escape this, right, they can send their capital to another country or, put it onto a USB drive, which obviously didn't exist back then. They would probably take these options, these exit options. And as you said, governments kind of actively block the exits to the theater while they burn it down. So how is this, and they go on to call this too the financial repression tax. What is the liquidation effect versus the financial repression tax versus negative real yields? Are these things all similar,
they're all
the
different.
same?
Yeah, they're all different ways of describing the same thing. I would say
Okay.
that liquidation of government debt is a result of financial repression, where financial repression is holding entities in these assets that are being devalued in real terms. And then the result of that is that, if the government's successful in that, they can reduce their debt relative to GDP, and that would be an effective liquidation of some of their government debt. And depending on the details of that country, the different methods would come into play. And so if you're one of the more desirable countries to be in, let's say the United States in the 1940s, where, out of all the world, which countries do you want to be in?
Right.
You can generally use some of the more mild ones. And if you're in some of the worse areas, you generally turn to the harsher ones, right? So the United States was less concerned about money fleeing out of the country and more concerned about, say, money fleeing into gold. So you generally block the thing that's better than you, right? So the United States says, okay, we don't want it going from dollars to gold. Whereas if you're Soviet Union, you want to block it from leaving the country because given the choice, many entities would rather have money in a more rule of law type jurisdiction.
Yeah.
And so generally when you get to smaller countries, authoritarian countries, emerging market, basically the further you are away from the most desirable places to be, they're more likely to have more draconian capital controls and more types of capital controls because they're further away from the center of where that capital wants to be. And so that's kind of again, it goes back to the spectrum where generally they find themselves mostly just having to prevent capital flows from what is better than they offer.
Right. Yeah. So the inhibition of freedom is essential to the duct tape and band-aids on these debt structures. Right. So they kind of go hand in hand. The buildup of this debt is creating more oppression, repression, and therefore divisiveness, conflict, all of these things. And I love the way you said that, blocking the thing that's better than you. Because in the US, we just needed to block gold, but abroad, they needed to block capital going into the US. And so is this, I'm reminded here of, I think it's called Exeter's Pyramid, the thing that's inverted with, gold's the most liquid and trustless asset at the bottom, and something like derivatives are at the top with a lot of counterparty risk built into them. You're basically trying to prevent people from escaping down that pyramid into gold, ultimately.
Yes. And you even see it today within, during the European sovereign debt crisis, even though you have multiple countries sharing the same currency, the euro, you would see these regional differences. Because if you're holding a euro in an Italian bank, that is, arguably riskier than holding a euro in a German bank,
right?
For example.
Yeah.
And so there's all these, whenever there's inequality between either regions and just literally specific inequality in that sense, referring to the specific unit, what would you rather have, given the choice, a German euro or an Italian euro, in the tail risk event that the eurozone breaks up and that a euro is no longer a euro and it's a it's a different type of unit,
Mm-hmm.
and then it gets devalued or maybe revalued, based on that. Um, there's different rules in place for how that capital flows.
Right.
And of course, on the far end of the extreme, you'd have something like North Korea. So even,
Right.
the United States executive order on gold wouldn't even be the most extreme. I mean, that was still is obviously it's extreme in a silly sense.
Yeah.
But obviously North Korea or something like that would be the true end of how far it can go, um, in history and present.
Yeah. Yeah. And what's interesting too, that so, I mean, just to insert the value prop of Bitcoin to some extent here, and I often argue, you need to understand the importance of gold before you can really understand the importance of Bitcoin. And so you get in this attempt to hold these debt structures together, we're creating more conflict, divisiveness, repression. You're creating this pressure where people are trying to escape into the quote unquote neutral territory of gold, right? Something that's universally accepted and, relatively securable. And so I always often try to replay these situations in my mind. If had Bitcoin or something like Bitcoin existed at that time, how would the game dynamics have played out differently? And it just seems like it's much harder to ring fence these tax bases or certain forms of capital to tax in a world where liquid wealth moves with much lower friction.
Yeah, technology definitely impacts the tools that people have, that authorities have to restrict the flow of capital.
Mm.
And that's one way, when I looked at Bitcoin, when I describe Bitcoin to people, I say that it's so far the most, efficient, credible, and decentralized way to transfer value peer to peer.
Mm-hmm.
And so, before, if you wanted, before Bitcoin, if you wanted to restrict global flows of capital, right? If I want to send money to Japan, how do I do it, right?
Mm-hmm.
If I could stuff cash in an envelope and send it, but that's obviously limited. I
Mm-hmm.
could bring physically on some sort of transport, but of course that's subject to all sorts of customs and physical checks. So realistically, I would have to have my bank send their bank money. And
Mm-hmm.
so if the governments want to restrict that in some way or put rules on it or surveil it, they don't have to enforce it at the personal level. They just have to
Right.
enforce it on the bank level. And
Right.
that's easy to do. And so what Bitcoin does is it gives, everyone with an internet connection in the world and an ability to send peer to peer. And so the enforcement point for preventing that
Mm-hmm.
is on the individual level,
Right.
which is orders of magnitude more points to enforce
Yeah.
and more likely to stir up, you know, backlash
Right.
if they overstep their ability to enforce something and then they get pushback from that. It's a much riskier proposition to enforce. And so certainly technology plays a role in the tools of financial repression that are likely or unlikely to work. And you basically need higher levels of authoritarianism to
Mm.
overcome higher levels of technology and when it comes to moving money around. So for
Right.
example, maybe if you're North Korea or China, you could still restrict it, or restrict a lot of it.
Mm-hmm.
Whereas if you have some semblance of rule of law and freedom of speech and relative freedom of transaction, it's much harder to restrict things
Mm.
as technology enables more capital flows.
Yeah. So again, we're back to that. The number of enforcement points, right? That's effectively the cost of enforcement, or it's
Yes.
commensurate to the cost of enforcement for government, and that impacts their ability, right? That impacts their profitability as a taxing authority. Effectively, it's like there's a greater cost now to imposing this tax. This just makes me think, like, how much this is a big question, probably. How much of what you think we're seeing in the world today is a result of these technological changes that governments, I guess, are waking up to these new technological realities and the explosion of enforcement points? Is that related to this seeming clamping down. Governments seem to be trying to re-centralize power, maybe in the face of decentralizing technologies, something like that.
I think to some degree, I mean, I think this is the direction we're heading in. I mean, speaking of IMF papers, they've had papers along with the ECB on things like central bank digital currencies and how those would increase their ability to automatically do enforcement points. Basically, if let's say you ban cash, right? So, and again, you can mostly do it at the banking level and the merchant level. You can say, okay, we're not going to go and get every piece of cash out there, but we're going to say, cash is not legal tender. Banks, if they get cash, they either reject it or it's just one way. They never send out cash. They'll take cash, but they won't send it back out. And merchants, if you're accepting more than $5,000 worth of cash a year, you're going to be taxed extra or it's just not allowed. So you can effectively ban cash, and then you can encourage the use of software money, central bank digital currencies that can be programmed to be more captive. And so it's basically a way of doing coercion, with less friction.
Right.
And so there's basically a couple. So technology strikes both ways, and so it gives people more options, but it also gives those authorities more options to the extent that they can corral entities into using them.
Right.
And it also, one of the only profitable ways to do something when you have a lot of enforcement points is through high penalties, and that goes back to the gold banning that I mentioned, where you didn't have that many prosecutions, but you had 10 years in prison. So how many people would take that risk? And so it was actually pretty low cost to enforce, but it also wasn't, you don't need complete enforcement for it to work. You just need some semblance. You need to narrow the exit doors so that, maybe not fully, they're not like airtight, but they're constrained enough that the plan's working. And basically, I mean, you had some entities just hodled gold for 4 decades. It's not like all gold went to the treasury.
Yeah.
But you couldn't just publicly trade gold around, right?
Right.
So you added frictions, and so even if someone wanted to own gold, you just made it much less desirable. So if before you would have ranked gold a 10 out of 10 asset, you would have ranked the treasury, a 6 out of 10 asset.
Yeah.
Well, now they said, oh, well, now gold's like a 5 out of 10 asset because I face all sorts of risks and problems if I try to use it. And so, and I want us to win the war anyway, so I guess I'll hold the treasury, right?
Right.
So, it's about adding enough frictions to, get the behavior that's desired.
Yeah, like tweaking the game board, right? The incentives and the rules of the game so slightly to tilt aggregate behavior in the direction you desire.
Yes.
As a policymaker. So interesting. And it's just so interesting that the bottom of this game does seem to be gold ultimately, right? It's like the ability to enforce those types of policy actions is really premised on your strength of your law, the strength of your military, which is again, I mean, correct me if I'm wrong here, but the reason the U.S. is able to rewrite the rules of the global banking order post World War II is because, well, we won the war and we had the most gold.
Yeah, at least historically. And it was during the war, 1944, when they did the Bretton Woods Agreement. And basically, countries had been shipping their gold to the U.S. to protect it in the event that they were overrun. And so the United States had a ton of gold on its own, and then they were also holding the gold physically of other nations.
Right.
And it's gold, it's geography. So the United States was blessed with the geography it had. It was physically removed from the worst of the war. It had access to both the Atlantic and the Pacific Oceans. It had natural resources. It had all those details. And then military strength and the ability, a large population that is organized rather effectively. So basically, if you can get that access to gold, natural resources, organization, military, then you're essentially the one that can write the rules.
Wow. So yeah, a very interesting way, because we often say these things like very broad stroke, but I think this paper is kind of mechanically getting into how these things work. So I think it's very interesting. All right, I want to read one more a little excerpt here, and this is going to talk about the financial repression tax, just to detail that out. It says, quote, when controlled nominal interest rates coupled with inflation produce negative real interest rates, it liquidates or reduces the stock of outstanding debt. And we mentioned this earlier, we refer to this as the liquidation effect. However, even in years when the real interest rates are positive, to the extent that these are kept lower than they otherwise would be via interest rate ceilings, large-scale official intervention, or other regulations and policies, there is a saving and interest expense to the government. These savings are sometimes referred to as the financial repression tax. So the other element to this is that governments, being the biggest debtors on the stage, they're actually able to, by basically essentially planning the price, the interest rate, I guess you'd say the cost of capital, right? The interest rate, they're able to award themselves this benefit of lowered interest expenses. And that itself is a tax on the public as well. Is that correct? Or am I saying that wrong? Any of that wrong?
That's correct. I mean, basically, when you want to provision the government, there are a couple ways to do it. I mean, let's say hypothetically you're on a gold standard and you were literally dealing in physical gold coins. The government can't print gold.
Mhm.
And so to the extent that they want to spend something, they have to first be able to tax it from the economy that they govern, and then they can spend it out.
Mhm.
Whereas if they issue the currency, then the other way that they can tax some, they can spend some, but the extent that there's a gap, they have one of two methods. They can issue debt to pay for it, or they can just print money to pay for it. And usually they have rules restricting their ability to print money, because otherwise they would, hyperinflate within the first couple of years. I mean, basically, if you look at countries and fiat currencies, ones that have more guardrails or make it harder to just outright print money, last longer.
Right.
And so, you can kind of apply the stock to flow ratio for fiat currencies around the world, and ones that have more rules around their growth tend to last longer. And so in the United States, for example, I mean, we're obviously centralized, but the fact that you have some degree of independence between the central bank and the Treasury, at least slows down kind of the banana republic type of financing that you would see if there was a weaker institutions. And given, the long arc of time, those types of rules break down. Eventually you encounter exceptions big enough that it just gets overridden, like in the 1940s or, kind of in this current era. But the more institutions and guardrails you have, the longer you can get that to work well enough compared to, more failed countries and their currencies. But yeah, basically it's the Cantillon effect in action. If you are the issue of currency, you can give yourself deeply negative real yields. And then if you're a large, creditworthy, wealthy borrower, say a bank or a billionaire, you can also get, maybe the next lowest yields. And if you're on the periphery, if you're, below income and you're relying on, credit card debt or payday loans, you're going to have the highest interest rate. You're going to have actually a positive real yield. And so it extends out from the center. And that's partly some aspect of that is natural market pricing, where if I was going to choose to lend money to someone, I would obviously lend money cheaper to someone who I view as very creditworthy, compared to someone that is riskier. So that's normal. But then when you add certain regulations to it, you can basically, and you can even kind of steepen that structure with of course the government at the very center, because they're the issuer of it. So they're the only ones in the system that unilaterally can set their own rate.
The risk-free quote unquote creditor, right?
Yes. Yes.
Yeah. So there is a correspondence. I love this point. The more guardrails that are in place within a society to prevent just outright money printing, the more longevity that society tends to have, financially at least. So there's a correspondence here between the integrity of the money supply and the integrity of the society running on that money.
Yeah, I mean, for example, the reason I hold some dollars, right? So why would I hold some dollars, whereas if there's some hyperflating in currency, I would not hold that for 5 minutes. But why
Sure.
would I hold some dollars? Because there's some degree of credibility that 3 months from now, it's still going to be worth more or less what it's worth today.
Mhm.
And that's because we have various laws saying, okay, the Federal Reserve can't just print money and buy treasuries directly from the Treasury. They have to
Right.
buy them in the secondary market. And of course, the Treasury can sell them to the secondary market, and the Fed can just immediately buy it from the secondary market. So it's effectively money printing, but at least there's multiple parties along the way. At least there's some degree of transparency there about what's happening.
Some friction, as you said earlier.
There's some friction there. And of course, those rules are self-imposed. If you had a big enough crisis, Congress could say, well, we gotta just do what we gotta do. But at least until those rules are changed, you have some degree of, when you order fiat currencies in terms of their chance of failing in 6 months, the ones with these actual guardrails are going to be the ones that have a negligible chance, and then the ones that are, less institutional protection. So, for example, Turkey keeps removing central bankers that don't do what the president wants, and so you have very little separation there.
Didn't the president take over the authority of Treasury at some point in recent years in Turkey?
I forget the nuances, but I don't know the detailed law of what happened. But basically they keep removing central bankers
frictions, as you're saying.
There's very little friction there between what the president wants interest rates to be.
Right.
And the reason we have some degree of separation there is because let's say the Treasury just set interest rates. If you're a president that's up for re-election in 6 months, you can say, well, let's cut interest rates. Let's get everything awesome for these 6 months prior to my election. And then once we're elected, it's like, okay, now we'll raise rates a little bit.
Yeah.
And so you can't, so it's kind of like having a staggered term, even though obviously the central bank officials are in part put in there by presidents or former presidents and Congress. There's at least a number of people have to agree to put that person there. And also there's other, the banks themselves also in the United States, because of the way we've got this kind of public-private institution, there's also banks, putting people there. And so they can say, well, I'm just going to keep, they're not forced to do something at the behest of the president in a short period of time. Now, historically, there have been instances where presidents of very persuasive character have kind of really hardly nudged the central bank to do something, and if push comes to shove, they can, if they have all of Congress on their side, they can pass laws and just fully capture the central bank. But basically, there's just more frictions there about outright manipulation and outright, literally micromanaging, say, money printing relative to an election or something like that. At least more parties involved have to do it. So it's like having nuclear codes where like two generals have to like put their keys in to launch it instead of like one person being able to do it.
Right. Much more of a multi-sig versus just one guy holding all the keys.
Exactly.
So this is so just speaking sort of theoretically, philosophically, then I think, and tell me if you agree, disagree, or you think I might be wrong, that in theory, at least, the idea of Bitcoin being infinite friction to printing money would be really good for the integrity of a society running upon it.
Yeah, I would describe it that way. I mean, at least to the extent that it continues to grow and be adopted and over time enforce adoption. And so, we can go back to gold, for example. I think a really good philosophical question to ask is, could it have been different, right? Could the past century have been different? Did we have to have fiat currencies? Could we have been on some sort of free banking gold standard this whole time? And there's actually a reasonable case to make that due to the order of technologies that happened, it unfortunately kind of had to happen like this, because our speed of commerce moved quicker than our speed of money. And some of your research touches on this, like, salability across time or salability across space. So gold is saleable across time, but it's one of its key shortcomings, along with divisibility, is that it's not very saleable across space. And so once we invented telecommunications technology, and banks could update each other's ledgers around the world almost instantly. And especially as we got the internet and as we got all these technologies, just basically this increasing types of telecommunications over the past 150 years, our speed of commerce made it so that we had to wrap gold in some sort of claim for gold.
A promise.
And once you wrap it in a claim, it's begging for arbitrage, right? So And I think we have to ask ourselves today, why is, out of 200 countries, why is there not one gold standard? Why is there not one kind of free banking gold standard that just kind of practiced austerity and then did all the right things? And then they became, the closest you get is Switzerland, but even they stopped doing it eventually.
Yeah.
And so it's like the order technology and the incentive structure around it made it, much harder. And so, for example, if gold just had the properties where you could just teleport it around, imagine how hard it would be for policymakers to say, no, don't use that. Use this paper instead. So you'd be like, you'd laugh them out of office. You'd be like, why would I know? But the fact that paper was convenient for centuries as a representation of gold is what made it possible. The gold had enough frictions on it, enough inherent limitations that these government papers were at least a contender to gold. Maybe not in terms of salability across time, but in terms of salability across space. And you could add enough frictions to gold that it's hard to say which one's better for a lot of people, because it's like they have to use it in some form. And so you can make the argument that due to the order that technologies kind of had to develop, I mean, it's, you can't get Bitcoin until you get telecommunications channels. We've had 150 years of various types of telecommunications channels, that the speed of commerce just outpaced the speed of money for a period of time. And Bitcoin represents the first credible method where the speed of money is the same as the speed of commerce. And so to the extent that Bitcoin can, get through all these different challenges, right? There's the fork wars, there's bugs early on. There's a million altcoins that want to come and distract people and dilute the scarcity of Bitcoin and basically say, there's 21 million Bitcoin, but there's 10,000 cryptocurrencies and they're all those units. And so to the extent that it's able to grind through all of that, reach higher levels of adoption, if it does eventually become ubiquitous, then that should, in theory, make it much harder to do types of financial repression, because it's much easier to self-custody it, move it around, more portability options. And so that can restrict the tools. And it becomes somewhat of a race, because obviously the technology of Bitcoin, another thought experiment was something like Bitcoin inevitable? Once we developed, it's like that question of, is Bitcoin a discovery or an invention? And my answer is always that, there's digital scarcity is a discovery. But of course, Satoshi could have made Bitcoin 42 million units. He could, there's certain parameters that he could have chosen differently. So in that sense, it was an invention based on a discovery. And of course, the discovery was, we made computers, we networked the computers together, we did Merkle trees, we did encryption, we did all the pieces over time, and then someone eventually, of course, came around and inevitably found a way to put them together into something that does this. And so to the extent that the user interface continues to be improved by all these companies that are, building on top of it, making it easier to custody, easier to use, easier to send, Lightning Network stuff, all these different layers on top of it, to the extent that the community is strong enough to make it good enough to overcome all these other challenges, then yes, I think that can change the game to some extent.
Yeah, that's brilliantly said. And so in many ways, we're living through these second, third, fourth order consequences that originate with technological shortcomings of gold as money, right? It's like, we couldn't send it over a telecommunication wire, and there were economies of scale that led to its centralization, right? It's much easier to put it all in one place and issue paper or electronic claims on top of it. And the philosophical question's well taken. And I think technically we couldn't have done it, but it is possible to do. The problem is, once you introduce the claim, as you said, the temptation to arbitrage, or the temptation to misrepresent, right, to create more claims than you have gold, is not resistible by human beings. So we basically inserted the human element. And when I talk about the corruption of money, that's what I mean specifically. It's like we put this technological overlay on gold, and then we abuse that overlay into fiat currencies ultimately. Do you think now that we're on the philosophical topic, I'm really going. Do you think that the decentralization of Bitcoin custody, that's possible because now you can custody Bitcoin in any information bearing medium? There's no need to build a big Fort Knox or a central bank or a safe. Do you think that would lead to the decentralization of the power structures built on top of that over time as well?
I think so. As long as that continues to be successful, right?
Mm-hmm.
So, I think people should be cautious about assuming that Bitcoin is inevitable, right? I
Right.
mean, we're 13 years into this. We're testing out all of its features and shortcomings,
Yeah.
and we're seeing to what extent it enforces its will essentially on
Mm-hmm.
the world, right? So,
Yeah.
is it hard enough that it's almost inevitable that it has to be used by more and more people, that more and more people encounter it, and then it keeps kind of eating other monies
Mm-hmm.
over time? As these altcoins come and go, as fiat currencies keep devaluing, is Bitcoin easy enough to self-custody, and is it resistant enough to government restrictions on it?
Mm-hmm.
Is the game theory strong enough to make it so that Bitcoin can reach whatever critical mass it needs to resist, executive orders that would kind of,
Mm-hmm.
filter it out of most existence? Can it get big enough and entrenched enough before those pushbacks occur?
Yeah.
Because you can imagine a future where Bitcoin stumbles in some way. Maybe one of those early bugs was not fixed fast enough, and it
Mm-hmm.
damaged the reputation, or countries move faster on CBDCs, and then
Right.
they have a way to keep up and
Mm.
kind of keep it from hitting whatever critical mass it needs, which is hard to know in advance.
Yeah.
Um, and so again, so with the caveat that Bitcoin is able to get through those various frictions,
Yeah.
then yeah, I think it can change the power structure. I think I would describe it as the best shot that we have right now,
Right.
in order to have money move as fast, bearer asset money, not claims for money, but the actual money itself to move as fast as commerce.
Yes.
And so you would think that given, as long as there's not some sort of bug that's found in like most nodes right now, and then there's some sort of reputational damage or, things like that, as long as tail risks don't hit it, it continues to be, the most attractive way to, you know, the most attractive money that we have.
Yes. Yeah. Yeah. So, and I think we're teasing out a really interesting point here that the one of the primary determinants, in my view, would love to hear what you think, of the configuration of our geopolitical reality is really rooted in the nature of this technology called gold. Right, the fact that we needed to centralize it all in one place, we talked about earlier, it influenced the outcome of World War II, influenced the outcome of Bretton Woods. I think it influences where people live to some extent. It obviously influences the entire nature and structure of the financial system. The fact that we use all of this deferred settlement debt to accelerate our transactions because final settlement in gold it's prohibitively expensive, basically, and you can't really do it for a globalizing economy, at least. It's interesting how much of all of this reality is just a reflection of this technology we built ourselves on top of. And so it's interesting to think that, well, if gold then is now being potentially, Bitcoin's got a lot of things to prove. It's going to take a while. But if Bitcoin does disrupt gold, then the whole reality built on top of it is probably going to look a lot different. And that to me is a really interesting just point of philosophical consideration.
Yeah, and this, to the extent that sounds extreme to people, I mean, that's kind of the story of human history, is that physical realities dictate where we end up and what we do. I mean, so for
Yeah.
example, it's not an accident that our major cities are mostly built on rivers and coasts,
Right.
because that was the dominant form of large scale transportation.
Mhm.
And of course, when you have the invention of airplanes, you can somewhat bypass that problem. But of course, still for major shipments,
Yeah.
being situated near water is very important. There's also a source of power. You can have various ways to harness the power from that.
Mhm.
And so the fact that gold could be so centralized that trickles into how we structure society. That for thousands of years, you know, basically power came from having gold, being able to, because that lets you pay soldiers, and that lets you
Mhm.
enforce your will. And so by certain accidents of history, as well as just the details of what we have to work with, that's been how this works. And, going back to the whole banking situation, it used to be, let's say you have a free banking environment where banks, they have gold as reserves and they issue claims. If you deposit gold, you get a claim for that gold, and then they'll loan some of that gold out, or they'll make various loans. Their ability to make loans, which when a bank makes loans, they effectively create money. Money to the extent that money's credit, they create credit. They create claims on money when they make a loan. And if they have gold in their own vaults, they're constrained by their ability to make credit based on their assessment of risk, based on their chance of default, based on not wanting to do fraud.
There's skin in the game, basically.
Yeah, the skin of the game, risk of a bank run.
Yeah.
They have to be very careful. Now, if you then say, okay, so the gold's centralized in a bunch of banks, or at least a lot of it is. By being centralized in a bunch of banks, it's very easy for the government to say, okay, well, we're actually going to take that and put it into the central bank. Because again, you're not enforcing it on the person by person level, you're enforcing it on the bank by bank level, which is much easier to do. So then you get into the central bank, and you issue, so normal banks, instead of having gold in their vaults, they have claims. That they have bank reserves, they have deposits at the central bank. And so there's actually no more, banks never check how much gold they have before making a loan. And so that's why, so even at that point, if you're still on technically a gold standard, let's say, gold was at the banks, then it went to the central bank, then it went to the treasury. So all the gold's in the treasury, and technically the dollar is still pegged by gold at that point. But the problem is, at that point, it's already unsustainable, because the rate of new money creation is so disconnected from that gold. Banks are not checking how much gold do we have in our vault before we make a loan. And you even had a situation where the foreign sector, Eurodollar, banks, basically banks outside the United States with dollars, they could make dollar-based loans. And so you even had just entities outside of the Fed's jurisdiction making dollar loans and putting new dollars into existence. And these were technically pegged to gold and redeemable for gold by foreign official central banks, even though they were illegal for Americans to own. And so it was inevitable that the dollar was going to go off to the gold standard. That's why I say that, in 1971, the mistake was not made in 1971. That was like marking to market something that had been failing for a long time. You had, in the late 60s, you already had the crossover point that it was completely unsustainable. There were more claims for gold by the foreign official sector than there was gold. And so you had this multi-decade environment starting in Bretton Woods where gold reserves were dwindling, all this dollar creation was happening, and it was so divorced from the amount of gold, even though it was on a gold standard. And so that unique property of gold, or that just inherent limitation of gold, where it is challenging to transport safely and expensive to audit, and has these various forces that centralize it, kind of led to the ability to go around it and make currencies and have the whole story of the past century.
Wow, that's so interesting. Yeah, there are nooks and crannies where corruption festers because of gold's technological limitations, perhaps. And that what you're describing there with the euro dollars is interesting too, because those are kind of like the original stable coins, right? There too much demand for dollars abroad, couldn't get dollars through the traditional Fed channels, so they just spun up a peg, right? But it was redeemable to gold, to your point. Yeah, really, really interesting. That really enjoyed that tangent.